Ladies and gentlemen, welcome to the Sofi Weekly. Today is a very special day. It's the Super Bowl for us, SoFi investors, and it comes 4 times a year. So let's go ahead and I'm going to get everything ready. That way, whenever earnings results come out, we get them very early on. How's everybody doing? Late, let's fricking go. Late as usual. What are you guys talking about? Not late. No. I'm not late.
You do a stream at 6:55 in the morning and they still complain about you being late. Like, guys.
Isn't it like 8 there?
It is, it's 8 p.m. here.
Cool.
Which is great. It works out for me perfectly.
Yeah. Just a regular day for you here. Okay, so I'll have the earnings call ready to go. Ladies and gentlemen, I'll have my Twitter open and everything. So just in case there's some sort of problem with us getting the numbers, you can go ahead and DM me, and I'll be able to throw the numbers up. I'll also be watching like a hawk just in case Twitter gets to it first, or somebody with Bloomberg Intelligence or something along these lines. Don't worry, we will get these numbers. So to recap, everyone, let's go ahead and bring up, I already know what it is, so I don't need to look it up. It's $630 million is Wall Street's expectations for revenue, and 4 cents of EPS for earnings per share, which translates to about $40 to $44 million in net income. Let's go ahead here. Everything you have ever done has led up to this moment. Well, I don't know about all that, but yeah. Where is everyone else? Everyone else is late. There's supposed to be other guests, multiple guests. And I just checked the messages and they said they're running behind. That's fine. Okay. Numbers have not been released, so that's okay. Maybe data-driven investing got insider scoop that, oh, no, never mind. I was saying maybe you got insider scoop that we were going to miss earnings, so you decided not to show face.
Listen, it's both 4 or 5 a.m. here, so.
Jeez,
Yeah.
That's worse.
Did you get any sleep at all today?
Yeah, I got some sleep.
Okay.
Like 10.
DDI was telling me, he's like, I don't know if I'm going to sleep at all. I don't sleep during earnings. I was like, you're a crazy person.
No, it's not that I don't sleep. It's just that I wake up like during the night a couple of times, right? Like, I'm just excited.
I love how you call him DDI. His name's Chris. He's a real person.
You can call me DDI. It's fine. I'm both.
Well, he was
things.
presenting as Chris for a while, and then he switched to DDI for more anonymity. So I don't know what to call you.
Chris is fine.
Where's your shirt, Tevis?
My shirt?
Yeah, where's your
shirt? See, we both got SoFi shirts on, see?
Well, it must be nice, guys. Noto hasn't gotten around to me yet. They don't ship to Canada.
My wife found it at a secondhand store for $1.
Tanner, I think, made his own. He made a bootleg one, didn't you, Tanner?
I did, yes. Well, I didn't. One of my friends printed it out for me. They were like, this would be funny on stream. I was like, I agree.
All right, 1 minute.
1 minute, ladies and gentlemen. I am going to be refreshing as fast as I can. I don't know what will come up faster, like if it's going to be just in the quarterly results, I guess, and just pray.
Somebody said, take your shirt off. I think they said Chris, although they spelled the wrong.
Okay.
You don't want to see that. I'm an old man now.
Ladies and gentlemen, numbers are supposed to be released at 7 a.m. and then 8 a.m. is when the call is. We'll be here all the way through. There's enough numbers for us to break down across the board. Across both shows already, we're already at 1,000 people sitting in here waiting for these numbers to be released. Let's try to break some records, SoFi. Give us good numbers.
Stock is up 1%.
Oh, little Bloomberg Intelligence. Or was that the way it was sitting before?
No, it popped just a tiny bit.
I'm not seeing any numbers on Twitter even.
Classic SoFi late.
Except for that one time when they were super early. You guys weren't invested then, probably, when they accidentally released the report super early,
Yeah, it was
like hours
Yeah.
early.
stock popped
Yeah,
like
I remember that.
17% or something.
Yeah, it was like during market hours.
Yeah, it was during market hours, and somebody pushed the update on accident, and then somebody found it. It wasn't like linked.
Yeah, you can't make a move like that, and Bender or Vadim don't find you. I mean, you
Exactly.
got to be stepping carefully at SoFi.
I don't see anything yet. Still,
Oh, numbers are out.
Numbers are out.
5 cents EPS, 689 revenue.
is that adjusted net revenue?
689.
There it is.
Can someone put it up on screen? I'm still not getting it.
I've got it. Here, I've got their press release. Let me present it.
Net income of 61 million.
Screen.
Shares great. Net income of 61 million.
All right, it's up.
Okay, zoom.
697 million.
Where did it go? Where did my tab go?
Net income of 61 million. Wow.
There it is. Okay.
Travis, better send this to me right now. And
Okay, so let's see. Where's the members?
35% growth in members.
Go down. Come on.
Adjusted
756 million or 1,000 new members.
Wow.
That's way above what I expected.
I was 6,000 off.
That is a big number.
it had to, Chris. It had to.
I mean, you're not wrong. Whoa, 240 million net revenue in financial services. We were both at 210.
For financial services, man.
Contribution profit, 42% contribution margin. So $100 million in contribution profit.
Man, that's without invest or credit card. Like, honestly, this might be as profitable as lending.
Lending was 396 million.
Adjusted contribution.
Net revenue and 60% margin. So that means tech platform. Let's see. Tech platform 102.5. I had 103. So that's the first ever quarter above 100 million. At 32% contribution profit.
Dude, this is great news. This is everything we want to hear.
This looks
amazing. Please go down to Outlook.
Okay.
Outlook management now expects adjusted net revenue of 2.535 to 2.550.
So that's 100 million, 100 million, 85 million than the prior guidance.
Yeah. This implies a 22 to 23% annual growth. I have over 23%, so we'll probably get there by Q4 once they, increase it again. Financial services revenue is still expected to grow faster than 80%, and assumes lending adjusted net revenue will be at least 100% of 2023. We were right.
That's what we all said when they came out with Q4.
Yeah.
What was their total origination? Sorry, I'm going to find it real quick.
And it does look like they
$4.9 billion in personal loans, 943 million in student loans, and almost 500 million in home loans. That's a big number.
Dude, $6.3 billion of originations is massive.
The stock is only up 2.2%. That is a really big beat.
We need Noto on the call. 160 million tech platform accounts. That seems low, right? That's 4 million new accounts.
Yeah, I don't know. Like, it's only Galileo accounts. So,
well, they revised tech platform growth lower. So where is it? Tech platform revenue to grow at low to high teen percentages year over year. So before it was mid to high.
yeah, that's two. So that's the one, again, the tech platform, until we see the growth, I don't necessarily trust it, right? Like it's been disappointing. It's been the one part that I've been most disappointed with.
Wow, only 2 million Galileo accounts
Only 2?
from 158 to 160.
I thought we were 156.
I mean, I'm talking
All right.
quarter over quarter, but
The
So was I.
presentation is out. Let me share the presentation because that's easy. It's much
Here,
easier to visually digest. Or you got it?
Yeah, I'll got it.
Okay.
Members are up 756,000 new members. This is a new record-breaking quarter, and seemingly a little bit cyclical, considering last quarter was also year over year was also record-breaking at 717. New products were at 1.068 million, which was also record-breaking. Very good for Tevis for both calling out a spectacular quarter there. Galileo, yeah, you were right, only up 2 million or 17%.
well, not really, because we got to think year over year, right? So 137 to 160, right?
It's 17% growth, right? But still.
23 million.
You can look up how
2 million quarter over quarter.
Lending products increased 19% year over year, while financial services still increased at a 33% growth rate. Absolutely crazy.
Wow. The revenue mix. They have a new slide. Go to slide 8.
Yeah. How can I make this bigger? Okay. What is it saying here? These segments grow at a combined 64% year over year, now comprising of 49% of adjusted net revenue versus 39% in the prior year, which they're looking at financial services and tech platform net revenue. Yeah, very interesting. Wasn't any stuff that we weren't looking at ourselves, but yeah. What else? DDI, they put this in for you.
It's very kind of them.
Yeah, very nice. So they're looking at the loan vintages here and comparing them versus what was this?
Remaining, yeah, that's 2017. So that's the last
sorry.
time they were at the high end of their
2017.
loss rates. But they combined them all into one, which is interesting. Q4 2022 through Q4 2023. So basically all of...
I want to go back and look at where this was last quarter. Because are we still getting like the peak right now, or is it coming down? Okay, loan vintage as a percentage of the remaining unpaid balance. Okay, so this is looking at Q1 of 2020 to Q2 of 2024.
Yeah, they're just saying that they have to do like 10% loss rates for the rest of the loans in order to get to above their 8% life of loan losses. So the point is, loans are performing really well.
That was at 11% last time, though. So
was it 11%? I don't remember the exact number, but I trust you.
Okay. Quarterly adjusted net revenue was 689 million, and quarterly adjusted EBITDA, which was not expected to be a new all-time high, became a new all-time high. Roy, how you doing, man? What do you think about first, numbers, results, and everything like this?
Yeah, it's quite a beat. So yeah, good to see.
Trailing
it's almost 6 cents. It's 5 cents diluted, but it is 61 million in GAAP net income, and just because it's almost like 1.1 billion shares outstanding, but it almost rounded up to 6 cents of EPS. This was a great quarter, and even the tech platform showed at least a little bit of signs of life, right? Like it's too bad that they had to guide down a little bit, but what's the opposite of a silver lining? That's the gray lining on a silver quarter. Who cares?
The gangrene
Doesn't
lining.
make any sense. the gangrene lighting. I love it.
Once again, across the board, they came in higher than expectations. So that's from adjusted net revenue, adjusted net revenue, adjusted EBITDA, GAAP net income, and on guidance, they also improved that. So another smashing triple. We now expect to deliver GAAP diluted EPS of 11 to 12 cents. Wait, GAAP net diluted EPS of 11 to 12 cents. Oh, sorry, full year of 2024. Sorry, I thought it was Q4. I was like, what the heck am I looking at?
That'd be great.
Which means they kind of guided. This is what they usually do. So they guided down a little bit quarter over quarter.
Yeah, versus the beat.
Yeah.
Yeah. No, that's fine. We see that all the time.
Yeah. But Wall Street doesn't love it.
No.
I guess they love it a little bit. Up almost 7% now.
Up 7% now?
Yeah, it's at 11.95.
Sweet.
Jeez. Okay.
Sweet. I love this. This is probably my favorite. You know what? We've been talking about them on a trailing 12-month basis. Show it off, baby. This is not a negative business. We are making $214 million of net income this year.
Louder for Gary Gordon in the back, please. I never understood like why people would say, "Oh, it's like you can see the trajectory, you can see what they're doing on a quarterly basis." It's weird, but hey, now they can't even say that.
I think, Tanner, your 13 cents end of year is going to come true. There's no way they're coming 11 to 12. They're going to be 13 for sure for net income.
Yeah, I also think that it'll be 13 or 14 in my opinion.
It's so messed up, man. Like
my top line.
Just the conditioning that they have for us right now. Like every time I see 11 on the screen, I think 13. Every time I see 13 on the screen, I think 16.
Yeah, it's whatever. I cannot wait for this call. Like, what is the team about to say here? Okay, so I might have someone take control of this, and then I'm just going to start plugging numbers in for my spreadsheets and everything, which usually tells me a lot more in terms of growth rates and everything. Whenever I get to look at it through my numbers here.
They raised guidance, right? Like I'm reading this correctly, right? They raised this again.
Large increase in outstanding shares, or at least a little bit more than what we usually see. We usually see like 20 million new shares coming in. Now we saw about like roughly 40 million. But that's okay as long as we keep beating on an EPS basis, because that will account for that. But would like to see that go in the right direction, clearly. Any thoughts, guys?
Invest was down in terms of products for financial services. Invest was down year over year.
Oh,
they did lose a lot in the beginning. Was it up quarter over quarter?
I don't know about quarter over quarter.
Yeah, quarter over quarter is all that I care about, because there was 2 quarters that were not great. Yeah. Man, I was not expecting personal loans to come in that high. Not personal loans, student loan originations to come in that high. I wasn't expecting personal loans to come in that high. And that was actually pretty bang on, I think, with the home loan originations that I was expecting.
I think it's because of in-school loans. I said this in my preview, but third quarter, last year, they got a bump from in-school loans. I thought they'd get it again, and they're actually really close. They're like I predicted 950 million, and it was really close to that.
Well, okay, wait. Can someone take over for this presentation? I need to go take a look at PayPal. What's happening with PayPal?
Yeah, I'm looking at that too. So it's revenue, small miss. The EPS, a small beat. Free cash flow looked good. Wasn't as good as I was hoping. I haven't dug into the numbers at all, just the headline stuff. SoFi was on the surface, it looks like a much better quarter for SoFi versus PayPal.
Thank God. I'm just kidding. I had to pick which one to stream. Last time it was like PayPal was just freaking climbing, and I was like, man, I hold both of these, but I'm getting punished. Okay, man, I need to plug in my numbers. Deposits 24.4 billion. I don't even know how this relates. I need to see quarter over quarter. And I do only track the actually interest paying deposits. Tevis, if you don't start sharing the screen, I'm kicking you. Share the
I'm
screen.
only on one screen, dude. What do you want me to share?
What else are you looking at?
I don't have you guys up on my screen, is what I'm saying. Like, I'm looking at the numbers myself.
Okay, good. So share it.
No. What do you want me to share? You want me to share the presentation?
Yeah.
Okay. Any slides?
But he can put his numbers in his spreadsheet and then pull up pretty graphs for us.
Yes.
Okay.
2,000
sure.
people are waiting, brother.
I don't. Okay.
Move your fingers.
Okay. Hold on. Jeez.
Josh just said, would love to hear Noto talk positive and aggressively about tech platform future on this call. I mean, it's going to be hard right now.
Okay. Is this what you guys want to see?
Why do you guys look so upset? We're tired. I'm very happy.
Yeah, 6:17 a.m. So, hey, the nice thing is, like, we can see that the market is just pre-market, but the market for SoFi seems to be rewarding, and it's been quite a run up. Even PayPal looks like is recovered now to what it's doing in the pre-market, and they missed by 90 million on EPS, or not EPS, on revenue, although it's a beat on guidance and a beat on EPS. So we're in a bull market, and fintech is not dead. People were thinking that, bears were thinking that like 2-3 quarters ago, like fintech's dead. No one uses this junk. I saw someone yesterday saying, hey, no one uses SoFi at all. It's the invest platform and even the bank. And I'm like, man, there's a lot of nobodies there. And we can see that in member growth. So
Almost 9.4 million nobodies.
756.
Nobody is a much larger number than I would have expected. But hey, so is SoFi price right now. So
Tevis, are you just showing the summary results front page?
I can't see whether my screen is up or not, so I'm just waiting for you guys to confirm that it's up.
It's the summary results page. Yes.
Okay,
it's up.
great. Okay, I didn't want to disrupt you guys while you were talking, but yeah, what do you want me to show? So
Look at the
members up 35%.
Only
just 6,000 off.
Yeah, I just saw the members. Like we were like right in that range. And Chris, I don't know I think you were probably in that range too.
No, I was way lower. I only expected like 675.
Yeah, I think it's, it just comes down to the football, the perks, and then just a couple of overlapping trends. Like they did a lot of marketing that quarter too. Yeah, so like I think that the previous quarter 3 wasn't all Taylor Swift. Like as I was digging into the numbers, and that's what I was thinking with my prediction. And I was just amazed when you missed that one, but Tevis and Tanner and I were like within 10 million of our prediction, and it's right there. So
it's so funny because last quarter I was off by 7,000, and then this quarter I'm off by 6,000. Like, I mean, I'm rounding to round numbers, right? 650, 750. But yeah, it's crazy how like I think the 3 of us were super close to that range. Chris, you gotta get with it, man.
I'm sorry.
At a premium, your numbers.
Hey, but I was much closer on I think everything else like originations than you guys were. So
I mean, I didn't have
you win
origination.
some, you lose some. Yeah, well, when you only predict 2 numbers, Tevis, then
oh my god, you and Tanner have the same talk track.
Maybe you should listen.
Thing, Chris, is that I bumped my numbers up from like the 600s that I wanted to put them into 740 because of financial services revenue. And then I came under like 28 million for financial services revenue.
Yeah, I'm going to have to break down their financial services and figure out where that came from. That is a huge number. Like the 240 million, like I don't know, like it was what 180 last time? 180 million to 240 million quarter over quarter. It's not quite 240. It's 230 something.
But SoFi Invest came in positive this quarter, 62,000. new accounts, which is small but positive. Credit cards, once again, yeah, just going into the abyss. 4,300 new credit cards this quarter. I don't know where they're getting all this monetization. I'm going to assume it's lending as a service products, these sort of
Well,
things.
do you guys want me to throw up the report as opposed to the presentation?
No, the presentation is better for the screen, right? Because the report just we cycle through the report, but it's harder to parse the information.
I really love
Unless
that
you
they're
want to.
You hear that Chris has been doing YouTube for all of a day, Tevis. He's telling you what to do here.
No, it's fine. I love that they included this slide because it's so visual, right? Like it just helps people visualize how that revenue mix shifts. And that I think is going to be super important, right? Because it feeds into that narrative, right? Predominantly, this company was a lending company and a student lender and whatnot. And meanwhile, we were saying, hey, actually, it's more diverse than that. And because we actually plotted this chart out, and by we I say that very loosely, like Tanner and Chris, the guys who actually do this stuff, plotted this out, but we knew that it wasn't like 80% lending anymore. And now that they have this, and I hope that they continue this slide in the presentation going forward, you can actually see that, well, in fact, management at the beginning of the year said they wanted to be 50-50 in terms of lending versus financial services plus tech platform. And they're pretty much at that right now, 49-51. By next quarter, it's going to be closer to 50-50, if not 51-49 towards the financial services and tech platform side, with how financial services is growing.
Student loans, very interestingly, had about twice the amount of new loans this quarter than last, but the originations came in only about 200 million more, or roughly
Loan
about
platform fees. It's loan platform fees. That's why it seems like that's why they crushed on financial services.
Yeah, that's my expectation. It's a lot of like Fortress deal and stuff like this. So I wonder, what company or whatever that they closed this quarter that it actually showed up in. Loan platform fees. Yeah.
Man, if the tech platform can just get traction, right?
Yeah.
And start to show, call it 25% year over year consistent quarters.
I don't think they had this verbiage before, low to high teens, because I think
last time it was mid to high teens.
Yeah, exactly. And the one before that, it was low 20% range, right?
Yeah, it's a harder comp is part of it. So if you look at it on a quarterly basis, and it just it's lagging. I think next year there's some pretty big tailwinds. I was hoping to see some of that from the Synapse stuff in Q4, but yeah, it doesn't sound like it. So I honestly, like, if next year we see that low to high teens in the tech platform, it's like, well, the Bears were largely right that it's more than a bank, but it's not as much of the AWS of fintech as I thought. So, and I know eventually, like, they may grow into that, but yeah, that's been a disappointment. But that's just the gangrenous lining, and everything else is really, really good here. So I'll take it.
Can I also take this one off of my predictions? Because I said that guidance would say that lending was going to be up single digits, but they said in their verbiage at least 100% of 2023 levels. So I'm gonna take that one off as well. But I mean, look, we knew this from the start. We had predicted this from the beginning of the year. There's no way that lending was going to be down year over year, and in fact, we saw student loans, personal loans come stronger. At whatever point we want, I can switch over to the actual report. We can look at some numbers too.
What else are you seeing, Chris?
I'm just trying to, like, I was going through Noto's tweets just now.
Yeah, I saw him like put a fire emoji on like the lions, and I'm like, okay. But I see.
Well, but it's talking about like, yeah, it's talking about winning.
Yeah.
Let's see.
I think he had that one lined up because it was yeah.
PayPal's now down in pre-market.
Pre-market.
I got to take a look at those numbers.
You know, lots of people, myself included, the fact that SoFi had run so hard going into these earnings, and the fact that it may still sell off on these numbers, but it's up another 6%, right? Like we're almost touching $12. And I'm always wrong when I say this, but I don't see how at this point you would sell this off, right? Like the trajectory is, because there was a period where, growth was starting to kind of go flat a little bit. We just reinflected to higher growth, right? And then guiding up from 16 to 17% year over year revenue growth back up above 20%, like above 20% in your transition year is really, really impressive growth. I'm sorry, Brett. I apologize. But I like, these are the concerns that people have, right? Is that SoFi always sells off on their earnings, no matter how good they are. I can't see it happening. Maybe I'm wrong again. I'm always wrong. So
yeah, I think I'm right. I think the next, I'm already giving myself a pat on the back here, and it hasn't even come true yet. I think the next big bear case is going to be dilution. Like, I think they need to really slow this down, because it's just going to make their EPS numbers look even better, and then people don't have to worry about that. So, and the problem is that I probably don't see that happening in 2025 either, but that's probably a 2026 problem for them. So I'm curious about that. Okay, let me plug in all the contribution numbers so we can see it quarter over quarter and everything. But so far, contribution profit looks very exciting for every segment.
SoFi's price to earnings ratio went from -57 to +58 because now they're profitable on a trailing 12
on a trailing 12-month basis.
Just like shot up.
I don't know. Like, it just seems like quarter after quarter after quarter. If you do this for 3-4 years in a row, at some point, you got to start believing that they're going to continue to execute.
By the way, what Tevis said as far as the price to earnings stuff, on newly profitable companies, most of you guys know this, but just as a reminder for the audience, you do you, but PE is a great measure for a more mature company like PayPal, not for newly profitable companies. So be careful with that. Be careful with EPS growth year over year, because it's infinite right now. And then also with the PEG ratios. So once SoFi is a little more mature, those will be helpful. But right now, if you have people telling you that SoFi is overvalued based on a PE standpoint, or way undervalued because of EPS growth or PEG ratios, don't listen to them. Also, don't listen to them, as Chris will always remind us, if they're talking about free cash flow and SoFi.
Yeah.
Pet peeve.
Yeah, I'm sure free cash flow is going to be horrible this quarter because they originated so many loans. The other thing that's interesting, the guidance says that they'll be at least at a capital ratio of 16%, at or above 16% at the end of the year, which means that they'll, like, it's not like they're pushing their book, because they can get all the way to, like, previously they were down in the 14s before they had the, all the debt restructuring and everything. So there's a lot of room to grow. The other thing that's really great about all of this is the fact that they're inflecting to positive EPS and GAAP earnings means that, like, they get to keep that. It's pretty close to what they get for adjusted EBITDA is what their tangible book value grows by, and then they get to lend, call it 7x of that, right? So if they grow, their tangible book value by, call it 150 million, which is about what it is, that means that they can grow their loan book by $1 billion and stay at the same capital ratio per quarter. So it starts to become like a virtuous cycle at some point where they have enough GAAP net income where they can fund that loan growth quarter after quarter after quarter.
Yeah. So remember, guys, we also do not have all the numbers just yet. This is also another bear case, is that it's going to pump on earnings, but then once we see the 10Q, that this is going to change everyone's mind. It never does, but it does give us more insight into the numbers, because the 10Q for SoFi usually comes 2 weeks, 3 weeks after they report. So
yeah, but like nobody, and I'll say that very loosely, nobody cares. And the reason I say that is because retail doesn't really care about those numbers, but also analysts, they'll raise their price targets even before the 10Q comes out, or lower them, based on these numbers is what I'm saying, right? So they'll act, they won't wait on the 10Q. I just think that it really depends on how management's tone is on the call and what they say. But even in Q2, I was looking back to some tweets from the summer at the end of July when they reported Q2, and the stock fell, on those earnings results. And so we'll really see what ends up happening here.
I remember because I was bummed. I was in Paris with my wife, and I'm like, "These were great results. Come on." Anyway,
Yeah.
but,
Well, I don't know. I'm interested to see, like, from a just more technical perspective, right? Like, we're breaking through that $11.90 range. Like, maybe we touch the $12 range. Like, this is, areas that we haven't hit. Like, we're breaking 3-year highs on this stock, right? And so it's going to be an interesting ride, that's for sure. Because I mean, what I've been saying for quite a while now is that the moment we break these levels, and they're almost as impactful in the very short term as the actual results themselves, because the moment we break these levels, all of a sudden, like, you have price discovery from the market, and it forces everybody else to re-look at SoFi, reevaluate it. Maybe some people have looked at SoFi a year ago and they haven't really seen the numbers, and so they have that same perception of SoFi. But the moment it breaks 12, or it breaks some of these big levels, and they look on their screener and it says, hey, SoFi just broke a 3-year high, they're like, okay, wait, let me take a look at this stock again, because they reported earnings. And then they can reacquaint themselves. And that leads to a whole new wave of buyers.
there shouldn't be, from a technical perspective, there should not be a lot of resistance between here and 14, because it just felt like it bounced off of 14 3 separate times when it was like IPOE early SoFi days. And then it fell through really quick, and it's never been back at that level. So again, if you believe in the technical stuff, one thing that we didn't, that's in the press release, that's in the verbiage, but it says in the quarter, loan sales reached nearly 1.3 billion in total, which is nearly 5 billion in the last 12 months total. And that's exclusive of $1 billion in loan platform business sales.
Wait, how many? 5 billion?
So yeah, in trailing 12 months, it's $5 billion of loans sold. So this quarter was 1.3 billion.
Okay,
which is similar to what we've had.
What did you say for loan platform sales?
1 billion in loan, 1.0 billion of loan platform business sales, again, in the trailing 12 months. And that must have really accelerated this quarter to get those financial services numbers. I don't know what it was previously.
Yeah, or you're getting
seems
paid
like it's really big.
Forward flow or something. Because
possibly
isn't, like, that's 1 billion trailing 12 months. We just got 2 billion from Fortress alone.
And I still don't know. Sorry, go ahead.
Oh, are you going to say you don't know if that closed in Q4 or not?
Yeah, that's all I was going to say.
Yeah.
So
really, in the car.
Can I jump in a little bit on PayPal? I've just went through really
let's
quickly.
Do it. That's fine.
And they're talking about, like, basically what happened is the revenue came down slightly from expectations. There's a miss by about $90 million. EPS was a beat. And early products, as far as, like, the rebrand of the app, like, there's some phenomenal numbers here that we're not going to dive into because this is a SoFi thing. One of the things that stood out to me, they've been focusing on the PayPal debit card and Venmo as well. 1 million new PayPal debit card enrollments since September launch. And if you look at the actual snapshot, here's revenue. So 6%. This is dollar neutral year over year. That's not amazing. That's not what I was expecting. That's not what the street was expecting. But EPS beat. They rose guidance as well. Free cash flow is about what was expected as well. But yeah, non-GAAP EPS just continues to climb. And this was one of the last legs of the bear case right here, was like, oh yeah, PayPal keeps shrinking. And we saw it growing on a quarterly basis, but on a year-over-year basis, PayPal has now grown. And it's risen by 1% here. And it's like, oh, 1% is not a lot. Well, you're looking at 432 million active accounts. So yeah, it's a good increase. So I expect that'll continue to climb, especially as they push out new products. We can see that the typical mix shift here. Branded is continuing to grow basically at the same slower rate that what they do. What's really interesting here, and I hope that they put some color on it, is just the unbranded card processing. So, yeah, it's a good quarter. Amazing, not really, but guidance also they increased by a fair bit. And PayPal does a nice job of like showing what the prior was, so like if it's a slight increase, if it's no change at all. But they usually guide pretty conservatively. So I would say it's a good quarter. Great quarter, probably not.
Chris, I need your help with SoFi.
Yep.
Did you see corporate revenue?
No, I did not.
Negative 40.
Negative 40.
Negative 40 million. I'm rounding a little bit. I think it was negative 39, but net interest income was negative 40 on that. And I don't know how to break that down very well.
Interesting. The corporate borrowings and when they do the, I don't know. I'll have to look.
Which that makes their net revenue like
way better.
That's $700+ million, and they brought it down somehow due to some level of expense here.
Yeah, that's a huge negative number.
So Tanner was closest on that because I forgot to bring it down. All right.
Yeah, I don't know what the reconciliation would be. I don't know. Maybe we can follow up on that. I might have to ask. Like that one's a hard one to parse out. I could maybe ask investor relations and see if they have an answer, a better answer. Without the 10Q, it's really hard to figure out what happened there.
Isn't that so funny? There's a guy in this chat that could just go, I'll just ask the CFO.
I'm not going to ask the CFO. I will send an email to investor relations just like anybody else.
Can you imagine
the morning investor relations does respond to me pretty well usually.
They don't respond to me. So
I don't know what to tell you.
They respond to me insofar as they say, "Don't contact us again." That's pretty much all I get.
I also don't ask them constantly for any. I have never asked for an interview of any sort from investor relations.
Well, maybe you don't want to talk to them.
That's it.
Reach out to them.
You already got one.
Them to talk to me. And yet somehow people get this idea that I'm getting paid by them. I've never been paid by someone that talks to me so little. They do not want anything to do with me. That's fine. I'll still be a shareholder. I love you guys. It's just not a two-way street.
The stock is back down to about only 3% up. Not that really matters, but
I mean, like it's so early to be making calls. Like it's pre-market, but it's also pre-market before the call, so it's going to fluctuate. What are we looking at, Tanner?
I'm just looking at all the numbers, giving somebody or some people to look at stuff. Yeah, it looks like a great freaking quarter. I'm super excited, but I want to hear the earnings call and I want to hear what they're focused on. And I was even going through, I mean, aside from the corporate revenue, which you can see here, where's my
on the very right.
Yeah, you can see my mouse here?
I can't.
Okay. Anyway, roughly the bottom purple bar, aside from the very bottom, the second lowest purple bar, just right above that, you can see 39.971 million. Okay,
I think Tevis is somebody asked who's the youngest was. I think that's Tevis.
It's definitely not.
Or is it Tanner?
It's Tanner.
I'm the youngest.
Okay. Roy's the oldest. He's got me. I think.
There's two fathers and then two children. And it's funny because one of the children is the richest out of all of us. So everyone give a warm round of applause to Tevis.
I actually don't know. I'm like nodding, but I have no idea what anybody's portfolio is worth in this call except for my own.
It's Tevis.
Tanner's the only one that keeps his hidden, but we do know that he bought Nvidia in like 2015. So there's also
That is not even remotely true.
Now,
Those
I
are
will
made up
say
numbers.
on these numbers, at least the tech platform, I know it was disappointing, but it actually came in higher than my expectations. So, yay.
I don't think it's that this quarter, like 103 million is actually pretty good for this quarter because
It's
we've
all
seen
right.
such bad growth in the past.
Yeah.
Um,
Our expectations have gone like way down for it. So it's like,
That's
hey,
also
they
true.
did halfway decent. So it's like if you have a kid that gets like D grades and they get a C, it's like, all right, nice job. Let's go out to Applebee's.
I'm pretty confident they lost the Galileo client in the numbers. 1.6 million looks like massively off the regular beaten path. I could be wrong. It could just be no large accounts, and every quarter before that has been large account ads. But yeah, not 100% sure where those numbers come in, but yeah. Yeah. So also I want to hear about debit spend volumes. If SoFi Plus members are just continuously spending more, because I love to chart that out. That's super fun. Non-interest income, we have all those.
calls in 20 minutes.
Okay, perfect. Yeah, so what's the revenue split this quarter? Let's take a look at that. I guess that's what their new slide
that was
8.
the 49%, but I mean, a lot of that's financial services. So tech platform is going to be, because both lending and financial services are growing much faster than tech platform. So tech platform is going to be a smaller percentage.
Yeah, financial
Right,
services
overall.
238, lending platform is like 103. So it's more than double.
Which is crazy because it for the longest time was never like that.
Yeah, I mean, what do you expect with 80% year-over-year growth that they reiterated again?
Year-over-year growth this quarter.
Yeah, insane.
I mean, that means that they only have to get like 220 million or something, maybe 230 million next quarter in financial services revenue to hit that 80% plus guidance.
Yeah, but if you like, you know that if they're telling us 80 internally, the target's like 95.
Right. So, I mean, even if they go up, I was expecting around 240 million next quarter after growing another like 30 or like two. Yeah, they blew financial services out of the water. Now, maybe some of that has to do with corporate revenue, because the corporate revenue, right? They reconcile everything at the end of the day, and so sometimes if financial services outperforms, it's because like it got adjusted on the other end. But anyway, the adjusted net revenue number is great. It's way above what any of us predicted.
Take a look at this gray bar here going back, 4 years ago in Q3 of 2020 to sorry, this should be titled differently. All the way to Q3 of 2024, and you could just see how much the numbers change in favor of financial services. It's insane, the growth that's been here in 4 years. Yeah, it's about 100x.
Yeah, you
Right
should
around
make this you should make this like a stacked bar graph so you can also see the overall revenue growth as well, because like it's not that financial services is stealing revenue share from anything else. They're all growing. It's just this one is growing faster.
Yeah.
And
All
I
right.
get to do what Tanner did and put all these numbers into my spreadsheet.
You want me to put these into your spreadsheet?
No, I said now I get to do what you were doing earlier.
Yeah. Why did it not oh, sorry. Oops, this is my bad. Hey, dog. How's it going? There we go. There's your stacked bar graph.
Yeah, there you go. So financial services is orange. Yeah.
Whoa, they eliminated a bunch of members this quarter.
When you look at this, like lending or a technology platform looks so flat, like insanely flat in comparison with the rest of these segments.
Wait, what was this about them eliminating a bunch of members?
So, because if you look at new members, it's 756,000. But if you look at the it's 900 9.4, right? It's 9373, and then the quarter before was 8774, which means that like the delta there is only 600 or 599K.
Yeah.
So they like, but anyway, it's because so the net difference between the two is around 600K, which means that 157,000 members were eliminated from the platform, which means that they just took them off. They're inactive, they're not, or whatever. So it's fine, right? It means that the member numbers are more realistic. It's just a bigger number than it's been in the past.
Right.
Yeah, I wonder. I don't know that we'll get any detail on that, but that is interesting.
They might have it in the spreadsheet or not spreadsheet. They might have it in the earnings result presentation thing. Potentially.
They just continue to excel. Like, that's the basic takeaway, at least for me.
Yeah. SoFi did well, period. That's his write-up after this quarter. Yeah.
Good stock, more buy.
Okay. Tangible book value grew a ton this quarter. 2.4 $240 million in tangible book value growth.
That's a lot.
It is a lot. That's like what, 80% or 70% of what they thought that they were going to do for the full year of 2024 originally.
Yeah, those numbers were so sandbagged. What was it, 400 to 500 in the entire year, I think was what they said. Or was it 3 to 4? I can't remember now. I won't say it out loud because I don't remember.
Yeah, lots of tangible book. So I'm just reading one of the chat members. They said they added 1.05 billion in tangible book value growth so far this year.
Well, if you want to price them on tangible book value, you should be raising your price targets.
Yeah.
Definitely doesn't help, or definitely doesn't hurt the lending growth, though.
No. Cavarini's going to probably come back with like a 4 or 450.
He's not going to change his price target at all. He's going to say 4.
It's the dumbest thing. I don't know. Some people.
He's going to say the price to earnings is too high, so it must be a $4 stock.
I hope he does that, and he talks about free cash flow. That would be like, if you want to discredit yourself, like go ahead and just do that.
What was the
they just think about this company completely different than we do. Like, it's a completely different paradigm and a completely different lens that they see it through. Anyway, sorry, continue.
Is this their strongest quarter in history, Chris?
Yes. Like, unequivocally, yes.
I want a stock buyback. Yeah, we we saw those coming. That's perfectly fine.
Yeah, and for those that are maybe newer in SoFi, a buyback is a terrible idea because the money that they have, the cash that they have, they could lend against. They're a bank. That's one of their forms of leverage. So banks usually don't do buybacks, at least not like the Apple. So dividend eventually, probably, yeah, but not for a while. Although that will be asked, I'm sure, every single quarter for like the next 3 or 4 years until that actually comes in.
I don't agree entirely with that. I think banks do a ton of buybacks, but it will be much later.
Not relative to where SoFi is as a newer institution that's growing this much, and not relative to what tech companies and SaaS companies do.
TJ the Wheel Deal. How you doing, brother? He's finally up. I think both TJ and Data Driven Investing had trimmed some of their options on SoFi to just
Yesterday.
sort of de-risk a bit. What do you guys think about that play now?
I mean, I still think that intellectually it was the right thing to do, even if the stock goes up, right? Like, and to be completely clear, I still have way too much exposure to SoFi in my portfolio, right? Like, I am very much, it's percentage wise, it's bigger than it should be. And so I didn't mind to, and again, the only ones that I trimmed was 2025 leaps, which expire in January of 2025. So not that many months. And if we see some stupid reaction where the stock sells off 10%, which is what's happened, like, I mean, remember Q2 of last year, everybody was freaking out because the banking crisis had just happened in March and everybody thought it was going to be the end of the world. And they posted this really great quarter and they were up like 5 or 6% in the pre-market. And then the market opened and it dropped like 50, it was like 12%, like from like +5 to minus like 10% in like a half hour. And I couldn't, like, I still to this day have no idea. And then a couple of weeks later is when we went on the giant run. So the market's irrational, right? And the fact that I was up well over 100% on those, and I still have more than half of just those 2025 calls, right? Like I sold a little bit less than half. It was still the prudent thing to do, even though it, with 2020 foresight, which doesn't exist because I don't have a crystal ball. It was the wrong decision, or it might have been the wrong decision. We still don't even know.
We don't know yet. I'm trying to find this. There's where is it? I just had it up. It was talking about financial services products excluding digital assets and products excluding digital assets. What's all this about?
Oh, the crypto assets. Yeah, it's in the presentation on the lending versus financial services products ad slide.
What slide is that?
It's slide number 6.
Slide number 6. Financial services products was 40% when excluding digital asset accounts related to our transfer of crypto services in 2023. Interesting. Okay. Yeah, so they're at 30.
So one thing, sorry, go ahead.
Well, I just want to point out, like, we had a lot of crypto accounts. I didn't realize that. That's crazy. That was the difference between 33% growth and 40% year-over-year growth, which would be a re-acceleration in financial services if that's the case.
So I'll give you what the bears are going to say here, if you can share that. So these are the assumptions that go into the fair values. This number right here, the weighted average discount rate, the fact that this dropped by a full percentage point, but the benchmark rate actually did drop by more than that. But this is something that they'll kind of highlight, is that the fair values might have gone up a lot because of just changes in assumptions. One thing that's actually really interesting is, look at this. The weighted average annual default rate went down. So these are the assumptions that they make in calculating their fair values. They were assuming 4.8% annual default rate over the entire lifetime of the loans. Now it's at 4.5%. That is a huge, like, that's only 0.3. It looks small. That is a massive amount of defaults, like when you've got a $20 billion loan book.
Yeah, and depending on where you look at it, it's the lowest it's been from like Q1 of 2022.
Yeah, so this is something that the bears might highlight, and that's fine. I mean, we'll have the fair value discussion from now until the end of time on this stock. But this number is actually super bullish, because I was trying to figure out, I didn't see like net charge-offs anywhere in here. I'm still looking through stuff, and I don't remember exactly where it is on this. But anyway, Just something to kind of be aware of. Oh,
Yeah.
we've got 5 minutes till the call starts. Do you have it up?
Soon.
Oh, yeah, I'll get
Stocks
it.
only up 2.5% currently.
It's fine. It can do whatever it wants for now.
Somebody says, absolute shit stock. I'm only up 70%.
That's an opportunity cost for you, right? 70%.
Okay, I have the call ready to go. Super excited for what Anthony Noto has to say. We'll be taking notes like madmen.
PayPal is down 6% right before their call.
I haven't even taken a look at the numbers yet.
Yeah, it's basically on that is Alex Chris has talked about driving profitable margin growth, and so some of that they've had conversations with different vendors regarding pricing, especially on Braintree. It looks like that's a drag on revenue, but all the other numbers look really good. So the market is very, very focused on revenue, doesn't care about profitability, free cash flow, active members, anything like that. That's all garbage. Just top line revenue matters, apparently. So. But I mean, it was a miss. So, and the stock had ridden up quite a bit. So 78 compared to where we were 3 months ago is phenomenal. So keep that in mind.
And on SoFi, I'm fine basing in the 11s for a while. Like, that would be fine with me. I don't think I would complain very much, right? Like, considering this time last year, we were like, well, this time last year, we were about the same level. But, it had stuck around the 4s for like a full year, the 4s and 5s. So 11s, I'm good with that.
And there is a lot of sentiment change on these calls. I find so like Anthony Noto can push the price in one direction or another by a large margin versus compared to other stocks, right? So
yeah, a lot of it's going to be what is lending going to look like, and like the amount of commentary they give on what 2025 looks like is going to be probably more important than any of the single numbers that we've spent an hour talking about. As much as like, and I do think I can't imagine that after this quarter that analysts can't come out and upgrade their numbers. Like, I just don't. I think we're going to see analyst revisions upward. I might be wrong, but at least in revenue and EPS, like I can't imagine after this quarter that you can't come out and
Dude,
and not
you've
revise
had
it upward.
analyst revisions upwards every single time. You're going to have it this time as well. I predict 2 or 3 analysts as early as end of day, and then 2 or 3 more by the end of the week. Dan Dolev even jumped the gun last week with it, so you're going to have
right.
it. Yeah, he was right.
That's the weirdest thing to me, though, is when they do that right before earnings, like 3 weeks before, sure, but like, when you're
So
like
that
within
then
a
they
week.
can then they can say that they called it ahead of time, right? It's more.
Yeah, it's still weird. Do
It
that
is a
3
little
weeks
weird.
before, a month before, So
yeah, I'm very excited. Analysts, I don't know. It'll be different this time. Like now that we're trailing 12-month positive, I think that there will be well, I mean, also it's going to depend if we get any sort of 2025 guidance. If he just comes out and spills any numbers, which he absolutely could do, it'll be very exciting.
Yeah, if
Let's think about that.
yeah, we'll see if they talk about 2025.
They should be able to. They were talking about a few months ago, talking about their playing out all their expenses for 2025. So I'm sure they have some numbers in mind. And then, like right now, the stock can only go up so much because your outlook is based on 3 months. So, like, it was great that they improved it, but no, stop being in this call and go on your chat. It's time to go live. Call's ready to go, by the way. When is the earnings call? It'll be up in the next 60 seconds.
When it
And
launches,
then we'll
I'm
listen
gonna
to
head
them
out.
talk about forward-looking statements for the next 2 minutes.
Yeah, and then the fact that they're a one-stop shop for the next 10, and then it's just going to be juicy detail after juicy detail.
Super proud of the team. Delivered another record-breaking quarter. It's the entire prepared remarks is the first paragraph of the report, by the way, so you can follow along. They just read off of it.
Yeah, this is one of the things that Oh, sorry, we're going live.
This time, I would like to welcome everyone to the SoFi Technologies Q3 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, that would be star followed by 2. Thank you. With that, you may begin your conference.
Thank you, and good morning. Welcome to SoFi's third quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Good morning. Thanks for joining us today. I'm thrilled to share our results for Q3, which was the strongest quarter in our history. I want to thank our members and clients for continuing to put their trust in SoFi, and to thank our team for their absolute grit delivering another great quarter. Our results reflect far more than just 90 days of work. They show how SoFi is consistently achieving durable growth, how our innovation and brand building are attracting more members and clients to our platform than ever before, and how we are delivering strong and improving returns. I'll touch on these 3 topics before handing it over to Chris, who will share our financial and operating results. First, on SoFi's performance as a durable growth company. Q3 was another record quarter for SoFi. We built on the strong momentum from the first half of 2024, putting us on pace to significantly exceed our 2024 plan and firmly on track toward the 3-year outlook we shared at the end of last year. Here are some highlights. Adjusted net revenue reached a record of $689 million in the quarter, a year-over-year acceleration in growth to 30% versus 22% in Q2. For the first time, financial services makes up more than a third of our total revenue. The segment recorded $238 million of revenue in Q3, up 102% from the prior year. I could not be prouder of how we've scaled this segment over the past 5 years since launching these products through a tumultuous and unpredictable environment to now be a $1 billion annualized revenue business, growing over 100% with strong and improving profitability. And frankly, it's still day one. Our tech platform grew to nearly $103 million in net revenue, up 14% from the prior year. We continue to see a strong pipeline of potential partners that are striving to modernize their platforms. Combined, our non-lending segments grew 64% year over year and drove the company's overall growth of 30%. And now they make up a record 49% of total revenue, up from 39% a year ago, driving an important diversification of our business. We also recorded tremendous growth in key revenue drivers, members, products, as well as revenue per product in the quarter. We added 756,000 new members in Q3. That's up 35% year over year to a total of 9.4 million members. We grew products in the quarter by over 1 million to 13.7 million products. That's up 31% year over year, or 37% when excluding digital asset accounts related to our transfer of crypto services in 2023. The financial services segment drove 964,000 of those new products. Importantly, revenue per product was $81, up 52% from a $53 a year ago. We believe there remains substantial upside in both product growth and monetization. Our one-stop shop continues to attract great cross-buying behavior by our members. In fact, 32% of new products were opened by existing SoFi members, and 20% of our new members open a second product in their first 30 days. This is the power of the flywheel we have developed. In our tech platform, we reached over 160 million total accounts. That's up 17% year over year. Overall, we're making incredible progress in our shift towards more fee-based, capital-light, and lower-risk revenue sources. Combined, fee-based revenue made up $174 million, or a quarter of our adjusted net revenue in Q3. This revenue grew by 65% year over year. On an annualized basis, that's nearly $700 million in revenue. This progress was driven by a record quarter in our loan platform business, which totaled $56 million in fee-based revenue and is up more than 5x year over year, as well as strong growth in interchange, which is up 2x year over year. Chris will share more details on these areas in a few moments. On top of all of this work to diversify our revenue base to capital-light, high return on equity, and fee-based revenue, we also grew our lending segment in Q3. We seized on the improving rate environment in the quarter, our improving credit trends, and strong performance across all lending products to achieve a record $6.3 billion in loan volume and $392 million in adjusted net revenue, up 14% year over year. Looking back at the progress we've made over the past several years, it's fair to say that SoFi is battle-tested, given the scale, profitability, and growth we have recorded for the total company in 2024, with our largest and most profitable business lending barely growing. It should now be crystal clear that SoFi can drive sustained growth across the cycle. We've achieved 17 of 19 quarters of record revenue through a recession, a pandemic, a 150 basis point rate drop, damage to our largest and most profitable business, student loan refinance, only to face a 500 basis point increase in rates and the collapse of venerable financial institutions in our neighborhood. The innovations we have driven to scale our non-lending revenue, which are capital-light and high ROE, have enabled us to grow our total revenue by more than 20% year over year for 17 consecutive quarters, as well as grow both our members and products by 35% or more year over year, excluding digital asset accounts transferred in 2023. Our performance in the hard times is what gives me the strong confidence in our future. Today, we face fewer headwinds than any point in our history. We're heading into 2025 with the most favorable conditions of the last 7 years, with declining rates and a stable economy. With the most diverse business we've ever had, with more members in our ecosystem and more products that serve their needs than ever before. This brings me to my second topic, the innovation and brand building that drive our durable growth. The market for consumer financial services is massive and historically poorly served. A Mintel report found that just this year, 1 in 5 U.S. adults have been in the market for a new savings account. A similar number are looking for new credit cards. Those markets, not to mention those looking for new investment accounts, new checking accounts, new personal loans, new mortgages, and buy now, pay later, all grew year over year. Meeting all of a person's financial needs in one place with world-class products delivered seamlessly and digitally gives us a massive advantage. This is why you'll often hear me say, it's a matter of when, not if, we become a top 10 financial institution. To do so, it's absolutely critical that we build the unaided brand awareness to become a trusted household brand name. The awareness we generate for SoFi is highly effective at getting people to try a product. After becoming a member, they cross-buy into another product, then another. They recommend SoFi to others. This flywheel that we've created drives acquisition costs down over time and reliably generates profits that we can invest in new product innovations to serve even more of our members' needs. Our accomplishments in Q3 demonstrate the power of this virtuous cycle. First, we continue to establish SoFi as a trusted household name. We ended Q3 with our highest average unaided brand awareness of all time, up nearly 40% year over year to 7%. Our highly effective marketing engine continues to reach and engage new audiences. For example, Q3 saw the kickoff of the new NFL season at the award-winning SoFi Stadium. We unveiled a new brand campaign with LA Chargers quarterback Justin Herbert, inspiring people to reach their most important financial ambitions. We also launched new partnerships with Los Angeles Sparks forward Cameron Brink and tennis champion Venus Williams. And coming in January, the TGL presented by SoFi, a new tech-infused arena golf league with an exciting match play format across teams of top PGA Tour golfers like Tiger Woods, Rory McIlroy, Wyndham Clark, Xander Schauffele, and Justin Thomas, just to name a few. Second, we continue to innovate so people find unique value when they use our products, starting with our financial services segment. In SoFi Invest, we've seen strong engagement driven by new alternative assets, mutual funds, and money market funds we've rolled out over the past year. Overall, we're providing Main Street investors access to unique investment products historically reserved for the ultra-wealthy, like interval funds, private credit, private real estate, and private venture. We also launched our new directed share program, which offers a modern and streamlined approach to equity programs for companies looking to raise capital through IPOs. And we are expanding our award-winning robo offering later this year. Importantly, we are building the Invest business cost-effectively by appealing to existing members. 70% of signups are existing SoFi members. In SoFi Money, we reached record highs in accounts, total deposits, and direct deposit members. We grew member deposits by nearly $2.4 billion, and annualized debit spend reached $10.3 billion in Q3. We will soon improve our self-serve wire transfers, which, similar to introducing Zelle, will further expand members' money movement options. In our member team, we're beta testing a new Cash Coach product that will analyze members' cash across all of their financial products at SoFi and beyond, and offer various ways to optimize their cash. Whether it's paying down expensive debt, setting up an emergency savings fund, getting more yield on their savings, or making investments in a diversified portfolio that is appropriate for their goals. We're also on track to launch improvements to SoFi Plus, our premium membership tier, and are beta testing a new fee-based subscription option in the coming months. Over time, SoFi Plus will increasingly show the magic of our strategy, deliver incremental and unmatched value across our portfolio of products. In credit cards, we officially launched the Everyday Cash Rewards and the Essential Credit Cards, enabling SoFi to serve more people's spending and borrowing needs, whether it's helping them earn rewards or building their credit. In our loan platform business, what started as a decline monetization funnel has now evolved into an integrated loan platform experience, which now offers just-in-time lending. In Q3, the loan platform business grew 5x year over year, mainly driven by record personal loan volume. We expect this business to continue to grow as we shift towards even more fee-based, capital-light, and lower-risk sources of revenue. We also signed our first 2 direct insurance carriers for SoFi Protect, complementing our comprehensive financial services offering we've built over the last 5 years. Turning to our lending segment. In personal loans, our innovation has helped generate a record $4.9 billion in volume, up 26% year over year, including $1 billion originated on behalf of third parties for our loan platform business. In home loans, we grew total home loan volume 38% year over year to $490 million. Home equity loan volume was up 44% from the prior quarter as rates began to decline. Home purchase and refinancing volumes grew 23% from the prior year period. In fact, home refinancing volume was the highest we've seen since the second quarter of 2022. And finally, in our tech platform, we signed several new partnerships, including processing deals with 2 chartered banks in Mexico and a deployment of Galileo's Cyberbank Core for SoFi's new commercial payment services sponsored bank program. We launched additional fraud prevention solutions, the Galileo Instant Verification Engine, which we call GIVE, as well as Transaction Risk G-Score, both of which help clients enhance their security and operational efficiency. Our new secured credit with dynamic funding offering promotes greater financial inclusion and enables clients to help their customers build stronger credit. And lastly, we launched programs with clients signed in prior quarters, spanning cross-border payments, global payouts, financial literacy, and scalable payment solutions. On top of this relentless focus on innovation and brand building, we built our business to deliver strong and reliable returns well into the future. We achieved record profitability in Q3. GAAP net income reached nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year. EBITDA grew 90% from the prior year to a record of $186 million. all three of our operating segments achieved record contribution profit in the quarter. We continue to improve credit performance in Q3 and are firmly within the life of loan guidance we've previously provided. As we've shared in our last call, delinquencies peaked in March of 2024. Since then, we've continued to see improvements quarter over quarter. Cumulative fair value adjustments, along with delinquencies on an absolute and percentage basis, all performed better in Q3. With all the innovations we've made across marketing, originations, and servicing, buyers continue to see compelling opportunities in SoFi's loan portfolio. Loan sales reached almost $1.3 billion in total this quarter and nearly $5 billion in the last 12 months. And finally, with our strong balance sheet, we are well capitalized heading into an improving rate environment. Our total capital ratio is 16.3%, well above regulatory minimums. In Q3, tangible book value increased $236 million to a total of $4.4 billion. We look forward to building on this momentum and delivering continued returns heading into the new year. In closing, I couldn't be more proud of what we've accomplished, not just for Q3, but for delivering a steady and consistent record of durable growth, incredible brand building and product innovation that help our members and clients, and strong improving returns for our shareholders. The future is bright, and I am fired up for what's in store. With that, I'll hand it over to Chris.
Thanks, Anthony. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the third quarter of 2024 versus the third quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. The record results we achieved across all three segments this quarter are a testament of our continued execution, our durable growth in members, products, and clients, and our diversification toward capital-light, fee-based revenue with increased returns. For the quarter, we delivered record adjusted net revenue of $689 million, with growth accelerating to 30% year over year, up from 22% last quarter. Adjusted EBITDA was $186 million at a 27% margin. This represents nearly 9 points of year-over-year margin improvement, demonstrating significant operating leverage across all of our functions, with expense margins decreasing year over year. Importantly, sales and marketing continues to decline as a percentage of adjusted net revenue, decreasing by 4 points year over year. We delivered our fourth consecutive quarter of GAAP profitability, with GAAP net income reaching nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year period. We generated GAAP EPS at 5 cents per share in the quarter. On a trailing 12-month basis, we delivered $214 million of GAAP net income, and when looking at the sum of our reported EPS over the past 4 quarters, we generated about 11 cents per share. Now on to the segment-level performance, where we saw record revenue and contribution profit across all 3 operating segments. Starting with financial services, we achieved $238 million in net revenue, up more than 2x year over year. We reached nearly 11.8 million products in the quarter, up 33% year over year, or 40% when excluding crypto accounts. We continue to improve monetization across all products, with annualized revenue per product of $81, up 52% year over year versus $53 in the prior year quarter. This growth was driven by higher deposits and member spending in SoFi Money and significant expansion of our loan platform business, which I'll describe in a moment. Both of these businesses achieved all-time records for revenue in Q3. We also benefited from new monetizable features in SoFi Invest and saw robust growth in credit card spend. We see significant opportunity for growth in these businesses, as well as SMB and Protect, which are all under-monetized today. Net interest income of $154 million increased 66% year over year, which was primarily driven by growth in consumer deposits. Non-interest income grew 235% to $84 million in the quarter, which represents nearly $340 million in annualized revenue. The key driver of non-interest income growth this quarter was our loan platform business, where we refer pre-qualified borrowers to origination partners and originate loans on behalf of third parties. Here's how our loan platform business works. With our best-in-class product, highly effective marketing engine, and network of respected buyers like Fortress, with whom we announced a $2 billion loan platform business agreement earlier this month, we can efficiently match the demand of members shopping for loans with the demand for high-quality loans in the capital markets. When a member takes out a loan, they gain all of the benefits of becoming a SoFi member, along with easy access to other products in our one-stop shop, even though we originated the loan on someone else's behalf. This enables SoFi to serve more potential members while also further diversifying toward less capital-intensive and more fee-based sources of revenue. In Q3, we generated $56 million in loan platform fees, driven by $1 billion of personal loans originated on behalf of third parties, as well as referrals. We also generated $5.5 million in servicing cash flows, which is recorded in our lending segment. Our loan platform business in total added $61 million to our adjusted net revenue. In addition to our loan platform revenue, we continue to see healthy growth in interchange, up 211% year over year, as a result of $12 billion in total annualized spend in the quarter across money and credit card. Overall, contribution profit for our financial services segment in the quarter was a record at nearly $100 million at a 42% margin, even as we continue to invest in innovation, acquisition costs that require a payback period, and new opportunities to rapidly grow this operating segment with attractive returns. Shifting to our tech platform segment, where we delivered record net revenue of nearly $103 million in the quarter, up 14% year over year and 7% sequentially. Revenue growth was driven by strong contribution from new clients, as well as growth in Latin America, consumer brands in the US, and clients with innovative use cases like earned wage access and money movement. Galileo accounts grew 17% year over year to $160 million. The segment delivered a record contribution profit of $33 million, representing a 32% margin. We've discussed before how the pipeline spans banks, brands, and fintechs across consumer and B2B, which offer larger and more durable revenue. The pipeline is in a stronger spot than it's ever been, and the investments made in this segment have greatly expanded the market opportunity. Recent wins and pipeline strength are early, but telling signs that the strategy is working. Moving on to lending, we achieved record adjusted net revenue of $392 million, with a record of $239 million of contribution profit at a 61% adjusted margin. These results were driven by 19% year-over-year growth in net interest income, while adjusted non-interest income decreased by 2% year-over-year. Growth in net interest income was driven by a 35% year-over-year increase in average interest earning assets, slightly offset by a 44 basis point year-over-year decrease in average yields. This resulted in an average net interest margin of 5.6% for the quarter. In terms of non-interest income, Q3 originations grew 23% year-over-year to over $6.3 billion and were driven by a record quarter in personal loan originations, which grew 26% year-over-year and 17% sequentially to $4.9 billion, with $1 billion originated on behalf of third parties for our loan platform business. Our student loans business saw origination volume grow 3% year-over-year and 28% sequentially to $944 million, our best quarter since Q1 2022. Home loans volume grew by 38% year-over-year and 17% sequentially to $490 million, our best quarter since 2021. In the third quarter, we sold portions of our personal loan, home loan, and senior secured loan portfolios totaling $1.3 billion. In terms of personal loan sales, we closed approximately $375 million of loans in whole loan form at an execution of 105.9%. These had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $504 million of home loan sales were sold at a blended execution of 102.6%. Additionally, we sold $81 million of late-stage delinquent personal loans in the quarter. As we've noted in the past, we typically have not sold delinquent loans until such a time that they are charged off. However, we have been able to generate positive incremental value over time in these sales relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we sold $312 million of senior secured loans at a par execution. In addition, one of our large senior secured loans with $594 million of principal outstanding was prepaid and refinanced by the borrower and is no longer on the balance sheet. Net, inclusive of new issuance in period, our secured loan balance decreased by more than $750 million sequentially. These transactions demonstrate clear market support for the marks on these loans, with $312 million of our senior secured loans sold at our marked value and another $594 million of senior secured loans prepaid so the borrower could refinance with another bank at more attractive rates. Turning to the profile of our borrower and the overall credit performance. Our personal loan borrower's weighted average income is $164,000 with a weighted average FICO score of 746. Our student loan borrower's weighted average income is $135,000 with a weighted average FICO score of 765. After seeing credit trends peak in Q1, we have seen continued improvement in personal loans. Our on-balance sheet 90-day personal loan delinquency rate was 57 basis points in the quarter, a decrease from 64 basis points in Q2, which is further evidence of surpassing a peak in Q1. Our personal loan annualized charge-off rate decreased to 3.52% from 3.84% in Q2, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 5.0% versus 5.4% last quarter. For our student loans, our on-balance sheet 90-day delinquency rate remained flat quarter over quarter at 12 basis points, while our annualized charge-off rate was 69 basis points. The data continues to support our 7 to 8% maximum life of loan loss assumptions for personal loans in line with our underwriting tolerance. Similar to last quarter, we've provided a loan vintage analysis on page 10 of our investor presentation. Since this only provides a partial window into our loan portfolio, we're unlikely to provide this same analysis longer term. However, it's a helpful illustration of how recent vintages are collectively performing against our 2017 vintage, as this is the last time that we approached 8% life of loan losses at 7.85%. You can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 to Q4 2023 vintages, soon after we made material cuts to credit, net cumulative losses of 3.3% are well below the 4.8% observed in the 2017 vintage at the same point of 49% remaining principal balance. The gap between the newer cohort curve and the 2017 cohort curve widened slightly quarter over quarter. Furthermore, looking at page 11 in the investor presentation, you will notice that only 43% of unpaid principal balance remains from our Q1 2020 through Q2 2024 origination. Among the 57% of principal that has already been paid down, we've seen 6% in net cumulative losses. For life of loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of more than 10%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at a 105.7%, 142 basis points higher quarter over quarter. This was driven by a 97 basis point decrease in the discount rate to 4.78%, which was directly driven by the drop in benchmark rates by 113 basis points and offset by 16 basis points of spread widening. The constant default rate, or CDR, also decreased by 28 basis points, which is consistent with the observed credit trends I just highlighted. For our student loan portfolio, the fair value mark increased by 183 basis points to 105.4%. This was driven by a 45 basis point decrease in the discount rate to 3.99% due to an 87 basis point decrease in rates, but offset by 42 basis points of spread widening. The weighted average coupon on the portfolio also increased by 17 basis points. The fair value gains in the quarter were significantly more than offset by our hedge losses and the negative impact from spreads widening. Net, we did not see a positive impact on the reported revenue from the change in marks, net of hedge losses and new originations. Switching to our balance sheet, where we remain very well capitalized. Assets grew by $1.7 billion as a result of nearly $1.4 billion growth in loans and approximately $226 million of an increase in cash equivalents, and investment securities. On the liability side, member deposits grew by nearly $2.4 billion to nearly $23 billion, while overall deposits increased to $24 billion. We reduced our broker deposits by $445 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack. Currently, there's a 220 basis points difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to more than $500 million in annualized interest expense savings, given the size of our deposit base. We exited the quarter with just $1.3 billion of warehouse debt drawn. This difference continues to support our net interest margin of 5.6%, underscoring the benefits of having the option of holding loans on balance sheet when advantageous in collecting net interest income. We continue to expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix shift towards deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.3% remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $6.1 billion and tangible book value by $236 million sequentially to $4.4 billion, with tangible book value per share at $4. Now on to guidance. For the full year 2024, we now expect to deliver adjusted net revenue of $2.535 to $2.550 billion, which is $85 million higher than our prior guidance range of $2.425 to $2.465 billion. This implies 22 to 23% annual growth versus 17 to 19% previously. This guidance assumes lending revenue will be at least 100% of 2023 levels, financial services will grow more than 80% year over year, and tech platform will grow low to upper teens % year over year. We now expect to deliver adjusted EBITDA of $640 to $645 million, above our prior guidance of $605 to $615 million. This represents a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $204 to $206 million, above prior guidance of $175 to $185 million, and GAAP EPS of 11 to 12 cents per share, above prior guidance of 9 to 10 cents per share. We now expect growth in tangible book value of approximately $1 to $1.05 billion and continue to expect to end the year with a total capital ratio at or above 16%. In terms of member growth, we expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q3 results. We continue to demonstrate our position as a durable growth story, which is reflected in this quarter's strong results. Despite operating in unpredictable macro conditions, we've maintained a clear focus on executing our strategy, driving returns, and helping our members get their money right. We could not be more excited about the opportunities ahead of us as we continue our journey towards becoming a top financial institution. With that, let's begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. And our first question today comes from Dan Dolev from Mizuho. Dan, please go ahead. Your line is open.
Hey guys, Anthony, and Chris, great results as always. Can you give us some more color on the loan platform deals? Like, how do you make money here, and how does this differ from the prior quarters? Thanks again, great results.
Sure. Thanks, Dan. So overall, this is a great fee-based and capital-light revenue source for us. We're not taking balance sheet risk. We're generating meaningful cash fees upfront at time of transfer or referral, and we're able to serve the needs of more members at a more rapid pace than we've been able to do so before. So there are several ways that we make revenue within the business, which has certainly evolved since we started focusing on decline monetization in 2019. First is we send qualified borrowers to platform partners via our Lantern marketplace, and we receive a referral fee if the borrower takes out a loan. The second way we make money is we can embed the specific credit box of our platform partners into our underwriting engine and originate on behalf of those partners, with the transfer of those loans to the partner occurring shortly after origination. For that, we receive an upfront cash fee, and we also retain servicing. The third way, and what's new this quarter, is that we're able to originate on behalf of other third-party investors based on a specific asset characteristic and return profile of that investor, with loans transferred shortly after origination. This is within days or a week. We receive an upfront cash fee, platform fee for that business, and we also retain servicing. And then the fourth way that we can make money, and we've been doing this for a few quarters now, is we can service assets that we do not originate but are held on the balance sheets of other third parties. For that, we receive regular servicing fees that are not capitalized. What I would say is important is in all of these cases, these are assets that we wouldn't have otherwise underwritten unless contracted due to a number of reasons, including first, the credit profile and other characteristics of the assets, which may not be directly consistent with our current portfolio. Second, our own risk appetite may not align with those originations. And then finally, our capital allocation strategy at any given point in time may not align. The last thing I would say here is that there are no financing commitments or loss share agreements associated with any of these deals or partnerships.
And the only other thing I would add, Dan, and this may not be known by a lot of people, but we decline between 70 and 80% of the personal loan applicants to SoFi. And so there's a lot of potential, latent potential there to service them better. And so that's a big number that exists before we even try to do anything else in this business in terms of generating incremental demand or other initiatives to make people aware of the products that we can offer.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hey, thank you. Good morning. So your originations came in ahead of our expectations, and it's increased each quarter of this year. Credit seems to be improving sequentially, and the macro probably a little bit less clear than earlier this year. So I guess going forward, how do you think about originations and lending growth for your own balance sheet versus maybe originating for some of your partnerships?
Yep. What I would say is our overall outlook for originations, or at least growth on the balance sheet, has not changed. We do expect to see modest growth in dollar terms on the balance sheet year over year, and that will continue into Q4. We are happy with the size of the balance sheet that we have today and the amount of net interest income that we're generating. We are seeing excess demand both on the borrower side as well as the loan investor side for our unsecured personal loans. And we've been able to successfully navigate and fulfill that demand through the expansion of our loan platform business. So we would expect not to grow the PL balance sheet meaningfully from where we are today. Where we will migrate into is in a lower rate environment, you would see an uptick in demand for our student loan refinancing business, where we had a really strong quarter this quarter, as well as our home loans business, where we had our best quarter since 2021.
The next question comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Morning, guys. Congratulations, and thanks for taking my question. I appreciate all the information, on the credit side about the 17 vintage versus the more recent ones. It looks like, the current vintages are performing better than the 2017 vintage. I'm wondering, how do you guys think about that, the contribution of that performance trend to like return on capital, and how do prepayments or your just payment assumptions, impact this outcome as well?
Yeah, thanks, John. So we often talk about underwriting to an 8% life of loan loss target, which obviously reflects the strength of our underwriting and the high quality of our borrower base. However, life of loan losses represents just one of several variables, which in combination actually drive our pricing and underwriting decisions designed to maximize return on equity while adhering to our credit risk tolerance. In terms of how we think about the returns on recent versus some of our past vintages, all-in returns on our more recent vintages are projected to produce meaningfully higher returns. I'm talking greater than 2x versus 2017, with newer vintages expected to produce ROEs above 30%. And I'm defining ROE here as the weighted average coupon minus annual losses, funding costs, and other operational costs, plus origination fees, and then multiplied by the weighted average life and levered. What's really driving those increases in returns is a function of a number of things. First is lower expected life of loan loss rates, as we show in our investor presentation on page 10. Second is the higher pricing beta throughout rate increase cycles. We've demonstrated time and time again that we've been able to maintain really good betas. We were successful in increasing the portfolio weighted average coupon across both products in a rising rate environment over the course of the last few years. And we've also been able to maintain pricing in down rate environments due to the quality of our product. The third way is we've had funding cost efficiencies given our higher reliance on member deposits and success in growing direct deposits and replacing higher cost warehouse funding. And then fourth, we've introduced origination fees over the course of the last year plus, and we're now generating close to $400 million in origination fees annually. So the combination of these drivers is more than offsetting the increase in prepayment speeds and the reduction in weighted average lives that we're observing in some of these newer cohorts. Going forward, what I would say is we're going to be talking about return metrics more often because these life of loan losses don't provide the full view.
And the other thing I would just emphasize, John, and everyone and the shareholders more broadly, is that we've been able to achieve these types of high ROE returns in more recent vintages, despite the fact that rates have been, increased significantly in a very short period of time, and the economy has been somewhat uncertain during that time period. As we look into 2025 and a declining rate environment and a stable economy, we think we can only improve on these returns, and it's one of the reasons why we're leveraging all the different businesses we are across the opportunity set that we have from a return standpoint relative to what we believe is a prudent level of balance sheet risk in a particular asset class such as personal loans. So we think there's a lot of upside and it only gets better from here.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey, good morning. Could you just talk a little bit more about the expectations for the loan platform business, how you expect that can grow from here? I know you said expect that to continue growing, but how meaningful can this become? It seems like, if we look at the numbers today, it's already at a $4 billion run rate. You've got the Fortress relationship, which, correct me if I'm wrong, is additive to that. So that's already $6 billion. And should we be thinking about the economics as close to a 5.5% take rate based on the revenues you reported this quarter? And then I'm just curious, are you going to maybe de-emphasize the loan sales a little bit more from here? I mean, it came in a little bit lower at the 375 versus the billion for the last 3 quarters, as you maybe prioritize the loan platform business from here. Thanks.
Yep. So I'll start, and Anthony can chime in wherever. But in terms of the overall growth expectations, what I would say is, as part of that $1 billion of originations that we did, Jeff, in the period, a portion of that did come from the Fortress transaction that we announced earlier in the quarter. So it's not additive to your $4 billion run rate. It's inclusive of that. but we do expect to see continued strong growth in the segment. We have that $2 billion agreement with Fortress, as well as commitments for Q4 and 2025 with several other partners. What I would say is we're one of the very few partners who can deliver assets at scale with the characteristics and return profile that investors are seeking. In terms of de-emphasizing other sales and ABS transactions in favor of this, what I would say is that, demand is as strong as it's ever been before. Like I had mentioned a few questions ago, we're happy with the size of the balance sheet and the modest growth that we're expecting over the course of the next 3 months. But what I would say is that we are seeing excess demand both from borrowers and investors, and a way to fulfill that demand is through the LPB business. In terms of the take rate, what I would say is we're looking at apples and oranges when you're trying to compare this take rate to what you see in the general originate to sell business. These are loans that are originated on behalf of others, and they would not have been originated unless contracted to, given the credit care and overall asset characteristics of the loans, as well as our own risk appetite and capital allocation strategy. What we're receiving is a platform fee for our underwriting capabilities, our marketing capabilities, and our overall operational capabilities, and that platform fee will vary depending on the partner.
And I think, a couple points just to emphasize. One is the partners in the loan platform business, many of which are new incremental partners on loans, as opposed to the wholesale loan buyers or ABS buyers that we've typically had. They're not all incremental, but a large percentage of them are, including in the most recent quarter. In addition to that, Chris has mentioned a couple times, these are loans we wouldn't have otherwise originated, and we only originate when we actually have a contract. So it's not a zero-sum game, it's incremental, and the outlook for is pretty significant as we go into 2025 in excess of what you articulated.
The only other thing I would say in terms of, you had mentioned $375 million of sales done in period. We did over $1 billion across all three products in the quarter, and $6 billion over the course of the last 12 months in overall loan sales. Quarter to date in Q4, we've already done close to $1 billion in sales across our products as well. So the demand is certainly there. We will continue to fulfill on both ends, but as Anthony mentioned, being able to originate on behalf of others is purely incremental to us.
The next question comes from Kyle Peterson from Needham & Co. Kyle, your line is open. Please go ahead.
Great. Thanks, guys, and good morning. Nice results. Wanted to ask a question on deposits. Some of the trends you guys are seeing there. You guys had really nice growth there, despite I believe you took down the rate paid on member deposits a bit, as rates have gone down. So just any color on whether you've seen any changes in average balances or customer behavior, or things have been pretty receptive to some of the changes you guys have made on deposit rates kind of early on in the rate cut cycle.
Yeah, we're really proud of the way the SoFi Money product continues to resonate in the marketplace despite rates coming down more broadly. We've maintained our market share position. We've maintained our ranking in an APY standpoint. Of course, we do not charge fees. We obviously give a number of other benefits, including the high interest rate, not to mention all the functionality you need in one place. So we've seen continued strong trends in deposits. Over $2 billion of member deposit growth in the quarter. In addition to that, the spending levels that we're seeing are on par to better to where they have been historically. And so we're continuing getting positive indicators across the entire business as it relates to SoFi Money. The other thing I would just mention is this is one of the key points of where the flywheel starts. Our direct deposit customers are customers that are more engaged. They have meaningfully higher number of products per customer compared to the overall average that we report. And when you look at it on a vintage basis, it's even better than the overall average number of products per direct deposit member. So It's been over a year in which we've operated this business as a bank and been able to control our own destiny and having a competitive advantage in being both an origination platform on loans as well as a national bank that can set its own interest rate and its own value proposition. It's a competitive advantage and one that's continued in the quarter, and we're excited about next year.
The next question comes from Mihir Bhatia from Bank of America. Mihir, your line is open. Please go ahead.
Good morning. Thank you for taking my questions. I wanted to stay with the financial services segment again. And I wanted to just talk about a couple of things there. One is just about monetization in the segment. I think it's up to $81 annually now. Any targets you can share on what you think that can look like maybe this time next year, or just, to achieve your 3-year targets that you laid out? Like, how much more monetization can that be? And then just related to that, I guess, what is the next growth there? You mentioned SMB and Protect in your remarks. You also launched the credit card more broadly. So maybe talk to us about where that next growth vector is materializing from. I guess really what I'm asking is what's the next lending platform business in that sector, right? Like, I think it was a pretty big surprise for a lot of people how much that business grew this quarter. So give us
you've hit the nail on the head, and thank you. You've hit the nail on the head. It's an exciting part of our business. The fact that we're approaching, $1 billion annualized business, very profitable while we're still in investment mode. It's pretty amazing to have a business of that size, $238 million of revenue, growing over 100% and profitable, despite how fast we are growing the number of members and products and revenue per product. And I think the best way to sort of conceptualize where this business could go is to think about those 3 variables: member growth, product growth, and revenue per product. The revenue per product that we generate today was up meaningfully in the quarter, as you mentioned, but it's nowhere near where it can be long term. As it relates to our invest business, we're monetizing at about half the rate that we think we can monetize it over time. In 2025, we'll take a number of steps where we start to monetize that better, of course, by adding incremental value to the invest experience. Our invest product is unique in that we're trying to be a one-stop shop just within invest. We pioneered fractional shares. We obviously don't charge on trades. In addition to that, we created our own ETFs that would better meet the needs of our new and beginning investors that are a lower price point but diversified, allowing our members to do dollar cost averaging in a diversified way. We have award-winning robo accounts, and we continue to evolve those, and you'll see us do more in 2025 behind that to not just grow assets, but also to increase monetization. We do IPOs, which is a direct monetization vehicle, but again, a unique product where Main Street investors get access to IPOs at IPO prices. And then our alternate asset classes and mutual funds that we launched have really been a tailwind for us in terms of driving more engagement. That's something today that we don't monetize that we will monetize in the future. So just in the invest business, we have a over 100% opportunity to increase the monetization per member, not to mention the fact how fast the products and invest are growing. And remember, when you do the calculation on invest product growth, you have to normalize it for the lost crypto members or products that we had a year ago that were transferred. SoFi Money Business, we continue to see nice trends in deposits and spending, and the monetization there will continue to improve with more deposits and more spending as opposed to a change in rate per se. In addition to that, our credit card business is another source of monetization opportunity. As balances continue to increase, we'll have more monetization there. In addition, the more members that we add, the more monetization that we drive, because that's a higher interchange revenue than our debit interchange. And so as you see a mix shift, you'll see an improvement in monetization there, not to mention just the absolute increase in monetization. And then as it relates to small, medium business, we're just scratching the surface. The biggest initiative we had so far in 2024 was to take the application process and embed it into the SoFi app. So when all the demand that we get for small, medium business comes to SoFi, they can, within the native app, apply for a loan and then be referred to a partner as it relates to lending. We also do that as it relates to banking. You'll continue to see us do that in a much bigger and broader way. There is monetization there today, but we could do more products and more services to drive greater monetization, not to mention doing it ourselves at some point, which we would like to do over time. It is a early stage business, and we want to crawl before we walk and then ultimately run. So you'll see that in the SMB business. On the insurance side, the deals that we're doing in the marketplace increase our monetization there, but it also increases penetration. So over 100% revenue growth in the quarter, driven by the really strong product growth and revenue per product. And if you just focus on those two measurements, you'll be able to forecast a pretty sizable business with great profitability. The last point I make on profitability is we're still losing a large amount of money in the credit card business and invest business because the payback there is longer. And it's not a business that we get return on in 1 year. It takes anywhere from 1.5 to 2 to 3 years, depending on the J curve of the credit business. So what's masking the profitability is that investment there. If we actually added back the losses that we're losing there, the number would be even bigger on the profitability side. And that's before we've improved any of the monetization.
I found this on the web.
The next question is from Peter Christensen from Citigroup. Peter, your line is open. Please go ahead.
Nice trends here. I was just curious, if bigger picture, can we talk about what you're seeing in the alt credit side? Private credit certainly becoming a theme. Some of your marketplace lending peers have also benefited here. In your discussions, pipeline, just curious if you think this emerging as a larger theme over the next 12, 18 months. And then finally, as it relates to tech platform performance pipeline, can you talk to the degree of decision delay you're seeing currently versus last quarter? Thank you.
Yeah, in terms of the demand for our loans from buyers or investors, similar to other people, the demand has increased quite meaningfully. We are better at being able to meet some of that demand by continuing to evolve our business from origination platform for our own loans and now the evolution of the loan platform business. So similar to others, we're seeing an increase from existing buyers, but also a number of new partners that we've not been able to meet their needs with before, but we now can. So really excited about the declining rate environment, putting a tailwind behind the loans, not to mention our new initiatives there. As it relates to the tech platform, no decisions have been made by any of the big deals that we've been in process with over the last 12 to 18 months. I do think we're coming to the end of some of those decisions being made, and I would just say that we haven't had anything to announce, but I would just tell you I'm confident that we will have some wins there, but none of the decisions have been made on any of the large deals. And I would just give you more color on the types of deals. There are definitely big financial institutions that have to make some decisions on their technology. They continue to really struggle with how they budget for that transition, but without a doubt, there's a technical reason why they have to switch, there's a risk reason why they have to switch, and there's a regulatory reason. And so it's going to be an inevitable change and tailwind to the demand for technology like we have in our tech platform business and specifically in core and processing. And it's just a question of when, and I think we'll win our fair share of deals there, but none have been decided yet. The second area that we haven't talked as much about in the past is the opportunity to help large branded companies that have big installed bases. They're in the financial services business already today through a credit card and a white label credit card. There's absolutely a significant amount of demand from those types of partners for us to do something very similar on the debit side of the business. And we continue to receive RFPs for that type of product. And then, of course, outside of the direct-to-consumer businesses, there's demand from government agencies, there's demand for B2B companies that continue to surface, and some of which we've signed and executed against, some of which will be decided over the coming months.
The next question comes from Jill Shea from UBS. Jill, your line is open. Please go ahead.
Good morning. Thanks for taking the question. You launched the Everyday Cash Rewards and the Essential credit cards while early days. Can you just talk about the early indications there and your view of future growth on the card products?
Yes, we really like the card business long term. It obviously is an expensive endeavor near term. There's a J curve of about 3 years in that business. We have a world-class team that's done this before. That wasn't the case when we first launched. The 2 cards that you mentioned are a direct result of all the work the team, our second team that came in to run this business has done. We did a test with the business. We saw the type of performance that we were hoping to see. Our marketing capabilities there have also helped us deliver the type of performance we wanted to see in those cards. And that's why we went general availability for those cards as opposed to just testing. I will say we will take a very methodical approach to the credit card business. While it is a great ROE business, it also does have the ability to lose a lot of money and lose money every day. And so we'll continue to make sure that that card is something that we market to individuals that we think have a high probability of utilizing it in the right way, and we can get a great return on it. So we'll start with our members, and we'll continue to use the data that we have on them to make decisions. We can use that data to model opportunities off of our platform, which we are starting to do as well. Inside of the financial services business, think about it as a couple of different types of segments. We have businesses that are still growing very fast that are profitable, like SoFi Money. We have businesses that are growing very fast and are losing money, like Invest and Credit Card. And then we have businesses that are early stage, and we're planting seeds that will continue to be harvested over time and grown over time. And this is a business that's in the middle, one that we feel we're confident in terms of our go-to-market, and one that will grow, but we'll do it methodically over time to make sure that we do not push too hard on the investment we have to make and offset the profitability of our overall business. But it'll be a good contributor.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Thank you, operator, and thanks for everyone that's dialed into the call. I have some closing remarks I want to share. As I mentioned at the end of Q2, I could not feel better about what we've achieved and where we're headed right here and right now. The list of achievements is far too great to capture every quarter, so let me be succinct and clear. Despite the tumultuous environment of the past 7 years, we've delivered durable growth, world-class innovation and brand building, and improving returns with 17 quarters of record revenue, consistent 35% plus growth in members and products, 4 quarters of GAAP profitability, and so many other milestones. There is only one reason we've been able to emerge stronger from such a tumultuous environment, and that reason is the people of SoFi, our employees, our members, and our clients. I could not be prouder or more grateful to the people of SoFi. We now face, hopefully, the most advantageous environment that we've seen since I joined the company, and we began the relentless march to be a one-stop shop. Today, we are no longer just a lending company. Today, we are a force to be reckoned with. It is truly our time as we have more products, more members, more capital, and more diverse revenue streams than ever before. We are undeniably the absolute best positioned company to capture the massive opportunities still ahead of us because of the same thing that got us here, our people. Our people are great at heart. Thank you, everyone, for your time today, and we hope you have a great end to 2024.
Goodbye.
This concludes today's conference call. You may now disconnect.
Make sure we all unmute. I just unmuted you, Chris.
Thanks.
How's everybody doing?
Not as much energy as the last call, but like the results, I feel like the results should speak for themselves. It was a really, really great quarter. We inflected back to growth. Like everything that I heard on the call was positive. Again, the exception is the tech platform, right? We're still just hearing the long sales cycles sort of thing. But Tevis?
Yeah, exact same sort of talk track from last quarter. I remember last quarter we were also slightly disappointed with the tech platform, and everything else beat our expectations. The closing remarks were not as strong as the last quarter, but obviously, I mean, that doesn't really matter.
But the opening remarks were better.
The opening remarks are definitely better, yes. Interesting stock price reaction. I think it just speaks to the amount that was been priced into this move. I mean, SoFi did run up 40% in the month preceding this report. So a lot was priced in. We'll see if it actually fades over, after the day opens. I think it probably will because, I mean, just going off of historically what it's done. But we're looking for it to find some footing in the double digits and, form a new base to climb higher. We don't want this thing to fall back in the single digits because that would completely demoralize, I think, the base. But, I mean, we are going to see more institutions buying. We are going to see more analysts raising price targets. The numbers that they're reporting is fantastic. And I found it really interesting how the majority of the analyst questions focused on that loan platform business, the fee-based revenue, and the run rate for that. I think that's something of, I saw people in the comments, making this comment, like it seems as though the perception is shifting more towards that and how that can adjust the multiple for SoFi as opposed to this AWS of fintech, which got punted back a little bit in terms of their talk track.
Yeah, I think entirely. It was like, I completely agree. The entire shift is to this loan platform business, which essentially what I liked about it as well is they were talking about underwriting for like risk appetites that maybe they don't even want to touch either. Now, I don't know what percentage of this is to, you know, large enough that it can actually replace like a percentage of what Pagaya was supposed to do. And they're sort of just doing it on their own with um, their direct members. But it is very interesting. They said a lot of stuff, zero loss share agreements for any of the partnerships. They don't do that. But the amount that they charge will be different depending on the size of the company and the, relationships that they might want to try to grow there. But it is true that they are, turning away a large percentage of their loan applications, and there is money out there that does want those loans. So, um, I did enjoy it. What did you think, Chris? Any other things that you highlighted there?
I mean, the loans are doing great, right? Like the delinquencies peaked in Q1, they came down in Q2, they came down even further in Q3. The net charge-off ratio went down. Now, part of that is because they originated an insane amount of loans this quarter, right? And that drops those numbers too, because loans that just get taken out don't default very quickly. But even still, like all of the credit risk is coming down. Like all the numbers as far as defaults and like I said, credit risk is way down, which means that like as long as they just keep going, like they're going to continue to make a bunch of net interest on all of those loans. They're going to keep growing the platform. They're going like, yeah, they're doing really, really well across the board.
Yeah, yeah. Okay, so they still did reiterate the when not if being a financial or top 10 financial institution. There was a couple of wordings at the beginning that I thought was very interesting, like going into the most favorable macro in 7 years for them.
Yep.
Unaided brand awareness is one of these statistics that's so up and down. I'm like, it's impossible to track. They continue to give a number where I think it's lower than what they've said before. They said unaided brand awareness is at its highest at 7%. I've totally heard Anthony Noto say it was at 11% before. They said there was a new product coming out for expanding their robo advisory offering either later
Yeah,
this
that was
year.
interesting.
Yeah. SoFi Plus subscription is coming in a few months with updated services there. So that should be interesting. Curious what the uptake of that will be. I think that there's a lot of people who are not potentially, employed traditionally, or they don't want to bring over $5,000 a month to SoFi that will end up using that product. So that would be very interesting. And yeah, there's just a ton of very interesting things throughout the entire quarter. They talked about SMB banking that will end up happening. It's just a matter of waiting a little bit longer, and they need to crawl before walking, before running, as he said.
So just one thing there, and also on the products, that this comes at a time where just put together the connect the dots. A few weeks ago, or maybe a few months ago now, they brought in the entirety of the SoFi leadership team to talk about 2025 planning and what do they have in store for internal planning for new product developments. And so this call, when they're talking about this in their opening remarks and also on the Q&A, they already know what they're going to be doing in 2025, and they know they have an idea of what the numbers are going to be and what the contributions are going to be. And so having that as a context, just reading between the lines of a lot of these things, I think is important, especially when the CEO comes out and says, hey, look, ever since I started, this is actually the best time. And, we're going to be a force to be reckoned with and all this stuff in 2025. So it speaks to just the confidence, knowing that they've spent several weeks in planning mode, and probably we're going to get a lot of that once we get the 25 guidance in January. But they already know all this stuff. We just don't know the specifics yet. And so all of these things that they're saying right now are hints.
Did they say that there was demand for the tech platform for government agencies?
Yeah, he said something about that.
I thought that was really interesting.
Maybe that's a FedNow thing.
Oh, okay. Yeah. That might make sense. Just in terms of money transfer and stuff like that. Okay.
Yeah, I have no idea, right? I'm just speculating.
Yeah. That does make sense. Revenue per product is nowhere near what it could be in the long run. That was I mean, it's clear, but still, whenever you start to put it out that way and think about it, it's like, monetization per member is still bottomed out. And if you can grow these users over time and they don't churn off the platform, then, we could see a lot of growth just internally with the current members that SoFi has, let alone if you're adding record numbers of 756,000 new members each quarter, Chris, what did you think about the gain on sale margins that we heard? The different statistics that you saw on the lending platform that we didn't see in the presentation.
I have to go back through that. Like I was typing and transferring numbers, so I didn't catch it. I'm gonna have to go back through the transcript and look at it again.
I heard, because they do go by so fast, that they said a blended execution of 105.9% gain on sale margin for personal loans.
That's the same as last quarter, and that matches the highest it's ever been.
And then home loans was really interesting, 102.4.
That's really high.
What?
That's really high.
Yeah, because I don't think it's been over 100 in a very long time. So 102.4 is like really good. And then student loans, I didn't catch it, or I don't know if they said anything. They might not have sold.
They might not have sold any student loans.
Yeah. Yeah, they definitely passed the peak of delinquencies in Q1 of 2024. I thought that was really interesting.
What was personal loans at?
What?
105.9.
Yeah. Okay.
Yeah, I think the home loans were more interesting. Although a smaller number, it's like relative to where it's been at, it's like a nearly a 2% increase.
The stock is down 2.5% on these results. It's so weird. It's okay.
Yeah. Last I checked, let me check again. Yeah, I mean the overall market is also down 0.2%. The SPY right now, so there is some general sell-off, but not as much as the 2% or 3% that it was previously, or for SoFi specifically. I really like the amount that they talked up their sort of fee-based revenue, and hopefully that continues to grow. But it is sort of lackluster that the tech platform isn't also growing in tandem. I think that that's really what gets us to that next sort of hybrid multiple, is if that was kicking off. But yeah. Anything else
So
that you guys?
I've got to get. I did want to put a plug. I'm going to be doing a live stream tonight for my first ever YouTube video. It'll probably be like 8 p.m. Pacific, and what is that, like 11 p.m. Eastern. So it's going to be late because I'm driving kids around all afternoon and most of the evening. But if anybody wants to join, you're welcome to.
Yeah, where can they? Is it the same for YouTube?
Yep, it's the same the Data D Investing.
Perfect. Ladies and gentlemen, I'm going to bounce over to PayPal's thing. Supposedly they announced a investor day, which I'm really excited. Hopefully SoFi does one of these someday. It would be great for the stock, but yeah, who knows? Tevis, anything?
No, nothing else for me to add. I'm just looking through the numbers again. I'm going to be probably looking through them for the next couple of hours. We'll see where this thing opens. But yeah, great results. I'm really happy with the numbers, records all across the board. They seem pretty confident for 2025 and what they're going to report in future quarters. And I mean, we have 4 quarters of profitability, 214 million trailing 12 month in net income. So it's all good things. It's all things that we were expecting. And I think that they actually came in higher than all of our forecasts across the board, even mine. And so this reaction to the sell-off, I mean, it's the natural reaction, I think, to something that's been so highly anticipated and priced to perfection to many in many ways. But we'll see what analysts are doing in the case of upgrades. We'll see what institutional accumulation looks like, over the coming weeks. We'll see what the short interest looks like over the coming weeks. And I wouldn't be surprised if Anthony Noto, drops some more awareness throughout the day in CNBC interviews and Bloomberg and whatnot. So overall, I think it was a great result and pretty happy with the numbers, but lots to dig in.
Yeah, that's definitely for sure. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But bye for now.